Welcome back, everyone, to the channel. Hope you're all having a great day. If you haven't already, make sure you subscribe and hit that notification bell. This channel brings you real crypto insights before they reach the mainstream. XRP holders, we need to have a serious conversation. A major structural shift is taking place right now that almost no one is paying attention to. Liquidity is contracting, Bitcoin dominance is building pressure, and institutions are positioning themselves much faster than everyday investors are aware of. If you're currently holding XRP, this could turn out to be one of the most critical periods of the entire year. Let's kick things off with the chart that silently drives the whole altcoin market. Bitcoin dominance has been ranging in the upper 50% zone following months of horizontal compression. No breakout, no breakdown, just coiling. And compression phases in macro markets never last forever. They always find a resolution. When Bitcoin dominance climbs, liquidity moves into BTC first. Capital seeks out perceived safety, and relative strength becomes concentrated at the top. Altcoins, XRP included, tend to underperform during these windows. Some slowly bleed out. Others chop sideways while Bitcoin soaks up available capital, delaying any meaningful rotation into the broader market. But when dominance eventually rolls over and breaks to the downside, everything changes. Liquidity begins rotating outward. Traders start seeking higher beta opportunities. Risk appetite spreads down the asset spectrum. That is historically the moment when altcoins begin catching serious momentum. XRP has consistently delivered its strongest relative gains during those rotation windows, not while Bitcoin dominance is expanding. So this is not simply a technical pattern on a chart. It acts as a liquidity valve, one that decides whether XRP receives capital inflows or gets cut off entirely. And right now, that valve is in the process of tightening. The broader macro environment adds another layer of urgency to this picture. Trade policy volatility has made a return to global markets. Ongoing uncertainty around tariff authority and the use of alternative legal frameworks to enforce trade measures means that policy risk is not going away anytime soon. When trade tensions rise, dollar liquidity has a tendency to tighten at the edges. Global funding markets grow increasingly cautious. Risk assets don't react to the news itself, but rather to the downstream effects those headlines have on overall liquidity conditions. Crypto markets don't move based on press conferences or political statements. They move based on liquidity. Macro pressure layered on top of thinner market depth produces amplified price swings. Smaller flows are capable of moving prices further. Sentiment can shift more rapidly. Positioning across the market becomes increasingly fragile. For XRP in particular, this dynamic is especially relevant because XRP exists at the crossroads of two separate narratives. On one side, you have speculative altcoin capital flows, and on the other, you have the cross-border financial infrastructure story. When liquidity is plentiful, both of those narratives can comfortably coexist and reinforce each other. When liquidity contracts, only the most dominant flows survive, and everything else gets filtered out. That brings us to something that has been quietly developing beneath the surface of the market: regulatory clarity. For a long period of time, XRP's broader narrative was weighed down by legal uncertainty and unresolved structural questions. Institutional capital does not flow confidently into assets that carry that kind of overhead. Those players wait, observe, and build contingency plans rather than committing capital. However, the dialogue around establishing a clearer and more defined digital asset regulatory framework has been picking up meaningful pace. The discussions surrounding legislation like the Digital Asset Market Clarity Act are not purely about how assets get classified. They are fundamentally about giving institutions the confidence they need to act. Regulatory clarity opens the door to custody confidence. It enables regulated token issuance. It allows on-chain settlement rails to operate within clearly defined legal parameters. Ripple has spent years cultivating regulatory relationships, building out compliance infrastructure, and forming institutional partnerships. While most of the market was focused on short-term speculation cycles, Ripple was positioning itself for a different phase entirely. If regulatory clarity progresses in a meaningful way, XRP and RLSD find themselves in a fundamentally different category than they occupied just 2 years ago. No longer fringe speculative assets, but genuine infrastructure components within the broader financial system. Now place that development on top of what is actively unfolding across global finance. Tokenized real-world assets, excluding stablecoins, have now reached approximately $25 billion in total value. More than 10 billion of that figure is made up of tokenized US treasuries alone. Certain projections suggest that number could push past $100 billion before the end of the year if the current pace of adoption continues. This is no longer an experimental phase. This is a scaling phase. Major exchanges and clearing institutions are actively constructing 24-hour on-chain trading infrastructure with instant settlement capabilities. Core financial infrastructure providers are bringing tokenized treasuries onto interoperable blockchain networks. Global banking institutions are issuing tokenized deposits and digital bond instruments. Institutional money market funds are being deployed onto blockchain rails to improve yield efficiency. Cross-border payment demonstrations operating on ISO 2022 messaging standards are no longer theoretical concepts. They are live operational pilots running in the real world right now. Look at the overall direction this industry is heading. Programmable settlement, interoperable liquidity pools, instant transaction finality, round-the-clock markets. That is precisely the environment Ripple was built for. The broader financial industry is progressively moving toward programmable value transfer and tokenized collateral management, and XRP was architecturally designed to bridge fragmented liquidity pools operating across multiple jurisdictions. As tokenization scales upward, bridge assets become increasingly relevant to the entire system. But here is where the important nuance comes in. All of this infrastructure development is happening against a backdrop of liquidity compression. Exchange data points to notable capital inflows into major trading platforms. XRP supply sitting on exchanges has declined relative to previous market cycles. Broader US dollar liquidity conditions remain thinner than during prior expansion phases. Thin liquidity creates fragility in market structure. Depth decreases. Smaller movements in capital produce larger price reactions. Upside squeezes can accelerate with surprising speed. Downside flushes become more pronounced and more sudden. Liquidity compression is not inherently a bullish or bearish condition on its own. What it is unstable. And unstable market conditions are historically the precursor to significant directional moves in either direction. Before moving forward, if you are thinking about positioning for the next cycle with a long-term mindset rather than short-term trades, the structure of your capital matters just as much as the assets you choose. Tax-deferred or tax-free growth structures can have a substantial impact on long-term compounding outcomes. Factoring in capital efficiency and tax structure is simply part of responsible macro positioning. Coming back to the core thesis, Bitcoin dominance is coiling at critical levels. Macro policy uncertainty is on the rise, liquidity is compressing, regulatory clarity conversations are accelerating, tokenization is scaling at pace, and XRP sits directly at the intersection of every single one of those forces. This is a convergence phase. Convergence phases tend to be uncomfortable because they generate conflicting signals simultaneously. The infrastructure picture looks constructive. Liquidity looks tight. The regulatory tone looks more favorable. Market depth looks vulnerable. But historically, convergence phases are what precede major expansion phases. The critical question is which direction expansion takes when it arrives. If Bitcoin dominance breaks decisively higher, altcoins may experience a further delay in rotation. XRP could temporarily lag as capital continues to concentrate in Bitcoin first, which is historically consistent behavior. But if dominance rolls over and breaks to the downside, liquidity rotates outward with force. Higher beta assets lead the move. XRP has historically performed strongly during exactly those types of windows. Positioning, therefore, becomes a matter of strategic thinking rather than reactive decision-making. Short-term traders need to respect the fragility that thin liquidity creates. Long-term holders need to keep their focus on structural tailwinds because the infrastructure build-out story is not losing momentum. Consider what is happening on the institutional product side. An S1 filing has surfaced for a proposed Coinbase 50 index ETF. This would be a basket product covering the top 50 digital assets ranked by market capitalization. Based on current market rankings, XRP would account for one of the largest individual weightings within that index, somewhere in the range of 8 to 9%. That matters significantly because ETF capital flows are not emotionally driven speculation. They are passive, rules-based allocations. Capital entering the vehicle gets distributed mechanically according to the index weighting. If approved, every dollar flowing into that structure would automatically allocate a portion into XRP as part of the basket construction. That is structural demand. And structural demand operates completely differently from retail-driven enthusiasm. It does not chase price action emotionally. It allocates according to mandate, rebalances according to predefined rules, and compounds steadily through ongoing inflows. Combine that with the continued growth in tokenization. If tokenized treasury assets expand from 10 billion toward 50 or even 100 billion dollars, collateral mobility across the system increases. Settlement speeds increase. Institutional comfort with operating on blockchain rails increases. Every step forward normalizes on-chain financial infrastructure as a standard operating environment. And XRP's core design philosophy is built around cross-border liquidity provisioning and interoperable settlement infrastructure. Returning to the immediate reality, liquidity compression remains the single most dominant short-term factor in the market. Inflows into major exchanges can serve as a signal of significant positioning shifts. Reduced circulating supply on exchanges tends to amplify volatility in both directions. US dollar funding conditions remain tighter than they were during previous altcoin season expansions. When liquidity contracts, market structure becomes reactive rather than orderly. That creates both opportunity and meaningful risk at the same time. Upside squeezes in thin market conditions can be aggressive and fast-moving. Short positions can unwind rapidly once momentum shifts. Traders chasing momentum can accelerate moves quickly once rotation gets underway, but downside liquidity gaps can trigger cascading selling just as easily. This is precisely why the current market environment feels charged with tension. The system is under compression from multiple directions simultaneously. Bitcoin dominance is compressed. XRP liquidity is compressed. Macro policy clarity is caught between competing legal interpretations and executive authority. Tokenization growth is pushing forward into a liquidity-constrained environment. Pressure is accumulating, and markets expand after pressure accumulates to sufficient levels. The error many market participants make is expecting that expansion will unfold in a clean and orderly manner. It almost never does. Volatility typically arrives before trend confirmation becomes obvious. Intelligent positioning means understanding that macro liquidity dynamics carry more weight than individual news events. It means recognizing that regulatory clarity fundamentally shifts the calculus institutional players use when making allocation decisions. It means appreciating that passive product formation has the potential to reshape supply and demand dynamics over time. And it means respecting what liquidity compression signals are telling you in the near term. Zooming further out, the digital asset space has moved through distinct evolutionary phases. The initial phase was defined by ideological debate, decentralization versus traditional finance. The second phase was characterized by speculative excess, ICO cycles, NFT mania, and aggressive leverage expansion. The third phase, the one that appears to be taking shape now, is defined by infrastructure build-out, regulated stablecoins, institutional-grade settlement rails, and modernized custody frameworks. XRP underperformed during narrative cycles that rewarded speculative hype, but infrastructure-driven cycles reward demonstrable utility. If cross-border settlement modernization becomes a strategic priority within a more fragmented global trade environment, bridge assets gain critical importance. If tokenized assets scale across sovereign debt and collateral markets, efficient liquidity routing becomes essential infrastructure. If ETF index products allocate passively across the top digital assets by market cap, weighting concentration becomes a meaningful driver of demand. And if regulatory clarity removes the existential risk that previously weighed on institutional confidence, capital allocation behavior changes materially. None of this comes with a guarantee of immediate price appreciation, but it does shift the probability distribution in ways that matter for long-term positioning. The core challenge for XRP holders right now is not a fundamentally bearish environment. It is instability. When convergence phases resolve, the resulting moves are rarely modest, and the majority of participants tend to be positioned reactively rather than having prepared in advance. Bitcoin dominance will not remain coiled indefinitely. Liquidity compression will not sustain itself permanently. Regulatory ambiguity will not persist without eventual resolution. Tokenization growth will either continue accelerating meaningfully or encounter resistance that causes it to stall. These are binary outcomes that will resolve over time. If dominance ultimately breaks lower while tokenization accelerates and ETF flows begin materializing, XRP could deliver powerful rotation-driven performance relative to the broader market. If dominance continues expanding and liquidity tightens further, short-term suppression may extend before infrastructure narratives reassert themselves with force. Holding both of those scenarios clearly in mind is essential because the volatility that is coming is not being driven by hype cycles. It is being driven by the mechanical resolution of compression that has been building across multiple market dimensions simultaneously. The real strategic question each person needs to answer is whether they are positioned ahead of expansion or whether they will be reacting to it after it has already begun. Institutional capital positions early and with intent. Retail capital tends to react after the move is already underway. That gap between the two is precisely where the most significant opportunity lives. This is not about calling an exact price target or predicting a specific candle on the chart. It is about identifying the phase the market is currently in and understanding what phases like this have historically preceded. We are in a compression and convergence phase. Those phases come before regime shifts, and regime shifts are what redefine the trajectory of entire asset classes. Bringing everything together clearly, Bitcoin dominance is coiled at levels that will not hold indefinitely. That single chart governs how liquidity rotates across the entire digital asset market. Macro policy uncertainty is introducing volatility into global financial conditions. Trade tensions tighten liquidity at the margins. Tokenized real-world assets are scaling at an accelerating pace with treasuries leading the way. Institutional financial infrastructure is actively migrating onto blockchain rails. Regulatory clarity discussions are advancing and have the potential to fundamentally reclassify how risk in assets like XRP and RLUSD is perceived by institutional allocators. Passive index structures are forming that could result in mechanical allocation into XRP if those products receive approval. Meanwhile, XRP's own on-chain liquidity structure is showing signs of compression that historically increase the probability of an outsized directional move when expansion finally begins. That combination of factors is combustible, not definitively bullish, not definitively bearish, but carrying the conditions for explosive movement in either direction. Thin liquidity combined with structural tailwinds and elevated macro tension creates amplified outcomes at both ends of the spectrum. This is exactly the environment where discipline and preparation separate from emotional and reactive decision-making. Short-term traders need to manage risk carefully and keep exposure calibrated to the fragility of current market depth. Liquidity gaps are unforgiving of overexposure. Long-term holders need to evaluate structural direction rather than reacting to day-to-day volatility, because infrastructure narratives develop and compound over years, not hours or days. If tokenization continues its trajectory toward triple-digit billions in total value, if interoperability becomes the standard expectation rather than the exception, if institutional ETF structures continue multiplying across the digital asset space, and if regulatory clarity brings genuine stability to the risk frameworks that govern this market, XRP's strategic positioning improves substantially relative to every prior cycle it has experienced. That does not eliminate the possibility of drawdowns along the way, but it does meaningfully change the long-term optionality picture. Markets have a tendency to underprice optionality during compression phases because attention and capital gravitate elsewhere. But professionals are watching liquidity metrics, dominance charts, regulatory developments, and infrastructure build-out progress simultaneously and continuously. And right now, all of those indicators are pointing toward convergence. The next major expansion move, regardless of direction, is unlikely to be a quiet or gradual one. When dominance breaks, capital rotation happens quickly. When liquidity returns to the system, volatility accelerates. When regulatory frameworks reach finality, capital confidence increases rapidly. When passive products launch and begin receiving inflows, allocations compound in an automated and ongoing manner. The question is not whether significant volatility is approaching. The question is whether you have a clear understanding of the underlying forces that are driving it. This is not decelerating. Infrastructure development is accelerating. Tokenization is accelerating. Institutional product structuring is accelerating. Liquidity is tightening. Compression is building. And compression phases do not persist indefinitely. They resolve. How you are positioned during convergence is ultimately what separates cycle winners from cycle chasers. If you found today's breakdown valuable, make sure to drop a like and subscribe to stay ahead of the next move. See you in the next one.